Walgreens Boots Alliance, ticker symbol WBA, is currently trading at $32.39, down 31% over the last year. What we're going to be doing today is looking at my stock valuation spreadsheet, then looking at a series of models I use to value the stock, discounted free cash flow model, the Ben Graham model, and the comparables company model to see Walgreens Boots Alliance is a buy or a sell. They have their earnings coming up, that will be on the 28th of March, and we'll see how that affects the stock price. But we'll be talking about what's been happening with the stock over the last few years. You can see they have been at a 52-week low at around about $30 a share, jumped up about 35%, back up to 40, and has been on a downward slope since then. If we take it even further, look over the last 5 years, back in 2019, this was a $80 stock. Even at the bottom of the pandemic, it's now lower than what it was pretty much then. But a lot of people still like this stock because of its almost 6% dividend yield. Is that a safe dividend? That's the question we're going to answer today. So let's have a look at my stock valuation spreadsheet. First, we will enter the ticker, WBA, and this will load up all of the financial information for the company. So as we can see here, currently it has a price of $32.63, a $28 billion market cap, PE, not profitable at the minute. Earnings per share, negative. So that is obviously going to be quite bad off the bat when we look at our models. Beta is 0.72, so should be less volatile than the S&P 500. But as you've seen, it is been decreasing quite a bit rapidly, and they have 863 million shares. Dividend yield of 5.88%. That means you'll get just shy of $2, $1.92 per share. They pay $1.7 billion in dividends, and you can see here from this dividend ratio, the payout ratio and the free cash flow payout ratio not looking good. Minus 55%, because you can see the net income is negative here, and the free cash flow payout ratio is over 100%. So it does not look sustainable at all. If we look at the revenues, it has been slowly increasing, but it has been all over the place. Pretty much 130 billion, give or minus a few billion, and the trailing 12 months is 132.9. So is it increasing? I suppose yes, but it's been relatively flat. Net income, once again, all over the place. 5, 4, half a billion, 2.5, 4.3, and then negative in the trailing 12 months. So what we'll do actually is, and check out my Patreon, that is up there if you want to get my stock valuation spreadsheet. I've got an interesting tidbit of something to talk about at the end of the video, but we'll get to that in a second. But if we look at the first quarter results of 2023, they had a big loss on the net income, which we saw. If I just scroll down a little bit here, you can see that the operating loss was 6.2 billion compared to 1.3, and the reason for this was a large which reflects a 6.5 billion pre-tax charge for opioid-related claims and litigation. So this doesn't look like something that will consistently happen, but it is still obviously a negative that we have to take into account. Next, are they buying back their shares? Yes, they are. They're rewarding shareholders by buying back their shares. And if we look at the share price, it turns out that was probably the right thing to do, because you can see the share price has been all over the place. They've been buying back the shares at lows in 21 and currently here. So if they do think the stock is undervalued, which obviously they're hoping for because they wanted to get back to those previous 81 highs, then it has been a good decision. And finally, free cash flow. Is free cash flow increasing? No, it's not. 6.9 billion to 1.4, and the dividend is not necessarily safe either. So not looking good at all. What we'll do is we'll quickly look at the trailing 12 months valuation, because we have that more recent data and they'll be more relevant in there. Actually, sorry, no, we won't. We'll look at the valuation, not including the trailing 12 months. So this will calculate the future free cash flows, discount them today's value, and that gives a calculated stock price of $250 a share, which seems obviously very wrong. And the reason for that is because if we look at the averages here, revenue growth rate I'm pretty fine with. The net income margins are very, very small here. So once again, I think this is okay. But the reason for is this net income to free cash flow rate. We can see that in 2020, because I had so little net income, but still positive, obviously it skewed the number. So let's bring this down quite massively to around about 50%, which is the most recent year. That puts it at about a $48 stock. And if we have a look at the trailing 12 months, that does give us a similar number. Let's see what that would be if we gave about a 50% there. $26 stock. So discounted free cash flow based on these numbers doesn't really like the stock at all. Next, we'll look at the Graham's model. We'll go through this quickly. The reason for this is because their negative is earnings per share, so it doesn't like, the Graham's model doesn't like it. But what do analysts think the stock will be growing at over the next 5 years? 3.89%. So if we change that now and change the earnings per share, if they were $1 earnings per share, oh, sorry, I forgot 3.89%. Oops, I can't type. 3.89%. If they had an earnings per share of $1, it would be a $10 stock. 2, 3, 4, then we're getting the prices. So depending on the next earnings is pretty key, where once we see what that is, then we can add that in here if they are profitable. But right now, Graham's model does not like it. And finally, we have a look at the comparable companies model. This looks at a series of metrics to compare against similar companies to give an intrinsic value of the stock. The companies that I'm going to look at, I've just got the tickers back up here. We will look at CVS, which is, of course, not them, CSV. CVS Health Corp, not that carriage company. Another one is HLF, which is Herbalife Nutrition Limited. And then finally, also a similar company, which is Kroger. I just wanted to get a 3 in there. So these are the EV to revenue numbers, which is enterprise value to revenue, EV to EBITDA, earnings before interest, tax, depreciation, and amortization, and then finally PE. So we will not be looking at the PE because Walgreens has a negative PE ratio. Sorry, not negative PE ratio. It doesn't have a PE ratio because it's not profitable. And if we compare the other companies, that they are profitable. So that is a massive negative right there, straight off the bat. If we look at the EV to revenue numbers, 0.5, 0.6, 0.7, 0.4, so it's pretty much in the middle. And that would actually give a value of around about $67 a share. EV to EBITDA, I suppose, compared to its most direct competitor, which would be CVS Health Corp, they have a much lower EV to EBITDA, which is obviously good. You want a lower number, but compared to Herbalife and Kroger, a bit higher. So that would actually give it, based on the averages, a $60 stock. And finally, obviously, PE ratio, non-applicable because it's negative. So these average at about $62 a share, which would mean it is massively undervalued at the minute. But with this negative earnings, I think we really need to see what happens in the earnings date coming up in a couple of days. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check out my Patreon. Link is in the description. And one thing here, we have Mr. Abid Siddiqui. He was a Patreon, loved it so much. You can see him in the bottom of my descriptions. He became a Patreon. I gave him access to my sheet, and it was so good that he stole it for free. So that's a good review there. This guy was willing to risk it all, commit illegal activities of stealing because he loves my sheet so much. He was willing to pay $6 a month, but he would rather have it for free. So that is a good review from Mr. Bede there. He's risked a life of criminal intent to get my stock valuation spreadsheet. So I'm quite pleased there. Right, guys, thanks for watching. Please subscribe and like and Patreon and all that fun stuff, and I'll catch you guys next time.